So we're here today with a share market update. Reporting season's in full swing and we'd like to cover off a couple of companies, BHP, CBA, Coca-Cola, QBE and Computershare. BHP was the first company off the rank and one of the biggest out there in the market. Underlying EBITDA, which is earnings before interest, tax and depreciation, was down 16%. And this was a relatively good result considering that the prices of the commodities, copper and iron ore, fell substantially. Basically, BHP's moved out of that expansion phase in the resources boom, and they're really into a volume and production phase. And we've seen some really good cash flows out of BHP over the years, but this was down 25% in the last result. CapEx and exploration was still quite high, being at $21 billion, which is quite amazing. However, they're really starting to focus on cutting that back and really looking towards making sure that they're doing the volumes, not spending as much, trying to pull back on expenses, and really looking to return some of the gains from the boom to shareholders. In that vein, their dividend was up 4%, which was a relatively good outcome. But they prefer to pay back through buybacks and really making sure that those buybacks are being done at the right price and are helping out shareholders. The first big bank to report was the Commonwealth Bank. They've delivered a really good report in what was pretty ordinary times for the Australian economy generally, and really quite slow lending patterns as people tend to want to pay off their loans rather than take out more. The highlights were earnings growth there on a cash basis of 10%. Earnings were up 10%, which was quite exceptional. Earnings per share was up 8%, which was a great result considering that the economy probably only grew about 3% in that period. What our shareholders look for and what we really want to deliver for clients is consistent income, and dividends per share from CBA rose 9%. And this is on the consistent increases that CBA's had over the years. We're really quite happy with that result, and that that their dividend payout ratio was relatively consistent, and it was only 75%. The tendency for banks to increase that payout ratio just to increase their dividend has been seen sort of through this last period as people chase yield, but CBA has actually kept that flat, which is a great outcome. Coca-Cola also reported in the last week, and what we've seen there from Coke is they're having a little bit of difficulty around sort of competing with Pepsi, trying to protect their market share. Pepsi's been trying to release their product Pepsi Next into the market, and doing so on price. They're trying to discount, and Coca-Cola's had to respond and make sure that they've discounted as well to try and protect their market share. Also, Coca-Cola's been having a bit of an issue with Woolworths and Coles. Woolworths and Coles are trying to squeeze Coke to try and take away some of their margin, and to try and make the supermarket businesses more profitable. And in doing so, this has caused a bit of an issue for Coke. And we've seen what has previously been really good growth. We're seeing a bit of a softening in their revenue. The revenue was actually off 6.2%, and this translated into a 12% fall in profit. Now, on the back of that, we like to see growing dividends, but at least if they're not growing, we like to see them steady. And Coke is a really great product. It's quality. People continue to keep wanting to buy it, and we think that the Coke's while it's being defensive at this point in time and trying to discount, we really want to see them do that and to try and maintain their market share. We think it's sort of temporary at the moment, and this is really sort of feeding into what's happening with the dividend. The dividend is being maintained at 24 cents a share, and there's a special dividend of 2.5 cents per share, which sort of indicates that the dividend is potentially flat for the moment and that the special dividend won't continue. For more info, follow us on Twitter, like us on our Facebook page, subscribe to us on our YouTube channel, or go to our website.